Hello folks, welcome back to a new episode. RALLYTOP Investing 3.0 SMC Masterclass here. In today's episode, I want to share with you my secret fair value gap trading strategy. Now, this is powerful and you need to pay attention. It is not the normal fair value gap strategy that you know of. So you actually need to follow me to the end of this video to be able to understand it properly. Now, first of all, what is a fair value gap? Well, in simple terms, fair value gap is when there is a gap in the market. It's as simple as that. The algorithm that drives the market is coded in such a way that it allows for healthy interaction between the buyers and the sellers in the market. But a situation where you now have only one participant, for example, like buyers in the market having dominance over the other participants, then it will create a gap in the market. The gap that is created by that action is what is known as fair value gap. And because the algorithm is coded in such a way to give a balance to both participants, price will have to find a way back to that point to fill it up before it continues in its intended direction. So basically, that is what a fair value gap is. Now, fair value gaps can dribble, because if you open your chart, you will find lots and lots of fair value gaps. But you need to know the fair value gap that is high probability. And that's what I'm about to introduce to you in this video. How does it work? Well, first of all, you need to be able to determine the structure of the market or the bias of the market. Is the market bullish or bearish? You need to determine that one first of all. Now, after then, you need to wait for a structure break, or if you like, break of structure. Number 3, the candle that breaks structure must be a momentum candle. I'm talking about a candle that has volume, because without volume coming into the market, as retail traders, I will strongly advise that you stay out of the market, because when there is volume in the market, it indicates that the big players are already in the market. So you want to ride the trend with the big players. That's essentially what we do as retail traders. Okay, so you need to find a momentum candle that breaks a structure, and the price must close above it. That is not breaking it with a candle wick. No, that cannot be a momentum candle. You need a momentum candle that will close above a structure high or low. And as you can see, that happened here. Now, one more thing here before I forget. When you are using this strategy, you do not actually need the advanced market structure that we have been teaching at RALLYTOP. All you need is a simple structures in the market, meaning that you are merely looking for higher highs, higher lows in a bullish structure, and lower lows, lower highs in a bearish structure. That's all. So you wait for a momentum candle to break structure high or low. Now, after that candle that took out structure high or low, you need to wait for 2 more candles. Why is it? It is because fair value gaps can only be determined with 3 candle formation. Okay, so once that candle breaks the structure high or low, wait for 2 more candles to be printed. Now, the catch here is that the middle candle of this 3 candle formation must have heavy volume in it, meaning that a lot of volume must be contained in that very middle candle, because that is where the difference is. Okay, even though all the 3 candles, we need volume in all the 3 candles, but particularly the middle candle must have heavy volume. You don't want to see a gap that is about 1 pip or half a pip. That's not the kind of gap you want to trade. You want to see a clear gap in the market. Okay, so if you take a look, this candle broke the high, this structure high here, and close above it. This is a momentum candle, and after that, look at these remaining two candles printed. Now look at the middle candle, look at the volume contained in this middle candle. That's the kind of thing we want to see. Okay, now if you look at the candle that broke structure here, the high of that candle is not interacting with the low of candle number 3, leaving this gap in the market. So this gap becomes high probability entry zone. Now take note of something here. You don't want to see, like for instance, this break of structure here. You don't want to see a gap before this break of structure. You want to see a gap after the break of structure, as you can see. All right, that's what you want to see. So this gap here is high probability entry zone. In a bullish structure, in a bearish structure, the concept is just the same. I'm going to take you to the live chart and show you 1 or 2 examples so that you can understand. It's a simple strategy or simple concept. You don't need to overcomplicate things. So let's get to the chart and let me show you 1 or 2 examples. Now if you look at this chart carefully, you can see that we are pretty much bearish. I said the first thing you need is to identify the bias of the market. Are we bearish or bullish? In this case, as you can see, we are bearish. Price took out this previous candle's low, all right, meaning that we are bearish. Now look at this low. Price printed this low after breaking this structure. It printed this low and pulled back up and came back down to take out this low. Look at it here. Very simple structures that you need to follow. So can you see that? It broke that structure there. Now take a look at the way the structure was broken. Take a look at the way it was broken with this candle. Let me zoom in for you to see properly. Now can you see the way this structure was taken out with this candle? Look at the volume in this candle. This is the kind of thing you want to see. This kind of candle, that's what you want to see, and it has to close below this low. Now after this candle, I said wait for 2 more candles to be printed, and that the middle candle must have heavy volume in it. And as you can see, this middle candle, it has heavy volume in it. Okay, so what you need to do is to mark out this fair value gap here. The low of this candle that broke structure is not interacting with the high of this candle number 3. Can you see that? Leaving this gap. So this middle candle is what makes the difference. So you need to stretch it out and wait for price to return into it. So sometimes you find price not returning to it, which is completely fine, and sometimes you find price blow through this fair value gap, and it's allowed because losses is an integral part of trading. Okay, so there's nothing anybody can do, any trader can do to stop losses in the market. It has to happen, and that is completely fine. So I want you to put that at the back of your mind. So this is the high probability fair value gap I'm talking about. I hope you got the idea now. So let's continue to play price and see whether price will really respect that. Okay, so as you can see, price tapped into this fair value gap and is going down. But again, let me show you one more thing here so that you can be able to understand perfectly what I'm talking about. Look at it. The normal structure here, this is a low, and price pulled back up to mitigate out of this fair value gap. But look at this one. Price later came back down to take out that low, which is a break of structure, normal break of structure using the normal structures. Okay, now this is the candle. There is momentum in this candle, as you can see. Now after this candle, you need to wait for 2 more candles to be printed for you to determine your fair value gap. But in this case, look at what has happened already here. This is the second candle after the break of this structure here, and but look at what it has done now, and even look at the third candle. So there is no fair value gap here going by what have I explained to you so far. Even though some guys will mark here as fair value gap, but this is not a high probability fair value gap. This one is not a high probability fair value gap, even though price return to it. But look at the way it is. It is not a high probability fair value gap. Why? Two reasons. Number one, it happened before the break of the structure. Okay. Number two, look at after this candle. Look at the candle that printed next with this wick. Can you see that? This is not the type of thing you want to trade. Okay. The wick is longer, is larger than the body. It's not the kind of thing you want to trade. All right. So I want you to understand that. So this has not met our rules. So that's the first example I want you to see. Now let's continue, because I want to show you one more thing. Let's just continue and see what happens here. Okay, so now look at this. Now here is another low. Okay, here is another low, and price pulled back up and came back down to take out this low. Now when it took out that low, look at the candle that took it out. It's with volume. This candle is with volume, and it closed below. And now I said wait for two more candles to be printed, and these are two more candles. Look at it. This middle candle has volume. Nevertheless, it has volume. You can't take that away from it. It has volume. But look at this. If we mark this as our high probability fair value gap, I'm not going to be sitting down here to show you only winning trades. Before some of you will come on the comment section and tell me that I'm only showing winning trades. I want to show you the reality of the market, so that you can have it at the back of your mind, that no matter how effective your strategy is, you are still going to be recording some losses in the market. But if you follow your trading plan, then overall you come out victorious in your trading. Okay, so now here is our fair value gap, high probability fair value gap, because this middle candle has some form of volume in it. Okay, even though it is not the kind of volume we want, but it has some form of volume. And now let's continue to advance price and see what happens. Can you see that? Price blew through this fair value gap. This is allowed in the market, so you don't need to beat yourself over this. This is allowed. Okay, so I just wanted you to see that one. Now let me take you to the next example in the market for you to see what we are talking about. Okay, here is another example. Take a look at this. I said to you the first thing you need is to determine the bias of the market. And where is the bias? What's the bias of the market here? Look at it. From this low, price printed this high, came back down to print this low, and then went back higher to print this high. So that's the bias of the market, as you can see. So we are bullish. And then the second thing I said to you, I said, now wait for price to take out structure high. And here is your structure high here. Now initially price took out that structure high with candle wicks. This is not valid. You need to wait for price to close above this wick, and as you can see, this candle close above this wick, validating this break of structure here as valid. Okay, now I said to you, you need to wait after the candle that broke structure. Wait for two more candles to be printed. These are the two candles that have been printed. Let me zoom in properly for you to see. These are the two candles printed, 1, 2. Okay, so that's how you to determine your fair value gap. Now I said the middle candle of the 3 candle formation must have heavy volume. Look at this middle candle. Look at the volume of this middle candle. This is perfect. Okay, and once you find that, you now have to draw out. Look at the high of the candle that took out this structure here. The high is not interacting with the low of candle number 3. Can you see this? It's not interacting. So this becomes your high probability fair value gap. That's your entry zone that you want to take trade from. So you want to wait for price to come into that. Okay, I'm just showing you high probability fair value gap and how to trade it. Okay, so once you find that, you now have to wait for price to come and tap into it and take you higher. You don't need to wait for price to come and tap into any OB. You don't need that. All you need is this. And now this has to happen after the break of structure. And now let's continue to advance price and see what happens there. Can you see now? We have been taken into the market. We have been activated. And so price, we want to see whether price will go our way. And as you can see, price is really going higher. Okay, price is going our way. Can you see that? This is very interesting. If you took this trade, so our TP would have been here. Say, let's say you go to for 1 to 5. Let's just look at it like that. So that's a decent trade. That would have given us how many? That's a decent trade, guys. That will give us about 7 hours, or if not more. All right, this is a decent trade. So that's how to make it. That's how to make it. I hope you understand what we are talking about here. Please go over this video again and again and master this concept. It will help you greatly. You don't need to wait for OB to be mitigated. You don't need to wait for that. You can use your fair value gap to take trades in the market so easily. Now let's do one more example, but before we do one more example, let me show you something interesting here. Now take a look at this. This is a high taken out, as you can see. So that high is taken out with this candle, this bullish candle, and closed above it. Okay, now this candle has volume, and now I said after this candle that took out this high, wait for 2 more candles to be printed for you to determine your fair value gap. Now take a look at these 2 candles, but I want you to take note of something here before you start bombarding me in the comment section about this. Take note of something here, guys. These are 2 candles printed, but look at it carefully. I want you to take time to look at this carefully. Now what is wrong with this setup here? Something is wrong with this setup here. Number one, some of you will look at this middle candle as a candle with momentum, but hey, wait a minute. Take a look at this wick, this candle wick. Okay, this candle wick, this wick is almost greater or larger than this candle body. Okay, or it is 50-50. Now will you call this a momentum candle? No, you can't call this a momentum candle. This is not a candle you should term as momentum, because what has happened here is that the bulls pushed price up before, but the bears jumped in and pushed price to this point and closed here, even though it closed bullish. But look at the fingerprint or the footprint of the bears here. Okay, so this cannot be a candle with volume, and I said your middle candle must be with volume. That's number 1 mistake. Number 2 is this. Look at this candle. This candle is contained, all right, between these candles, these previous candles high and low. So meaning that this is an inside bar, and you do not determine your fair value gap with inside bar. I want you to understand that. So these are the 2 things that are wrong with this setup here. But some guys will go ahead and then mark this as your fair value gap, and then go back to the comment section and begin to tell me it's not working, it's not working. Look at it. This is your fair value gap here now. Even though it works, even though it will go in your direction, but this is not according to our trading plan using this our strategy now. Okay, so let's see. Yes, price has reacted off of that, as you can see, and it's going higher, which is completely fine. It's all right, but this is not a valid setup. Using this strategy that I'm discussing with you now is not a valid setup. Now let me show you one more example here of a valid setup. Look at this. Price printed this high and pulled back, and then went ahead to take out this high. It took it out with this candle. As you can see, it took it out with this candle. This candle may not actually be a momentum candle, but nevertheless it closed above. Okay, now when it closed above, I said wait for 2 more candles. Look at these 2 candles here. Now I said particularly the middle candle of these 3 candles must be with momentum. There must be heavy volume in this middle candle, and look at it. This has very heavy volume in it. All right, once you find that, I said mark out from the high of this candle that broke structure, mark it out, to this. That's your fair value gap, high probability fair value gap. So you're waiting for price to come and tap into this and go higher. Is that correct? Yes. So let's see what happens. So we have been tapped into the market now, we have been activated, but let's see whether it will go our direction. So as you can see, price seems to be going our direction. Look at it. Has it taken us out? Let's see. No, we are still on course. So let's see. So can you see that? Can you see how price is going in our direction? This is very interesting, guys. If you can learn this strategy to understand it, it's very interesting. So, but I want you to go back test this first of all. Don't rush to your life account, please. Go back test this. If it resonates with you, then you can use it. Okay? Because what works for me may not actually work for you. But this is the way I use fair value gap to take high probability trade setups in the market. Okay, guys, if you are new to our channel, please consider hitting that subscribe button and become part of our family. And turn on the notification bell so that anytime we publish a new video like this, you'll be notified about that. And if you haven't joined our free Telegram channel, please do so just immediately. It's completely free. You're not going to pay a dime. All right, guys, thanks for watching, and I see you in our next educational video.